Hello and welcome to the Harts webinar on business valuations. This webinar has been recorded in two parts. Unfortunately, there were some technical issues when the live webinar was recorded and the first 5 minutes or so wasn't recorded. As such, we're now re-recording the first part of the webinar with the remainder recorded separately on our YouTube channel. I'll start with the obligatory disclaimer. This is particularly the case for valuations, that we're providing the following presentation for general guidance only, and professional advice should always be sought before any transaction is undertaken. This is particularly so with valuations. Every company is different, every individual circumstance is different. So, business valuations, and in particular the impact on business valuation of the current coronavirus crisis. I'll start by looking at some of the reasons why a business might need to be valued. Quite commonly, a valuation is required for good purposes, tax or succession planning. For example, a restructuring, a transfer of shares between related parties, an employee share or incentive scheme is being implemented, or there's a sole trader or partnership business which is being incorporated. However, business valuations are also required for less happy reasons. Divorce or separation of the owners. When a couple divorce, the courts will often want to split their assets 50-50. It's therefore necessary to work out the value of the business if one of them is in business so that the assets can be split. Similarly, probate valuations are often necessary. Even where the business qualifies for business property relief, there are other parts of the inheritance tax computation which are sensitive to the value of it. Sometimes we have an exiting shareholder, or management want to buy the existing owners out. In those cases, you've not got a completely arm's length third-party transaction, so we need to put a value on the company's shares. We don't see this one so often, but there are cases where a lender is coming in, making a major loan to a business, and therefore wants an idea of the valuation of that business before it will be prepared to make its loan. And then finally, what some of you might be thinking, what's my business worth if I want to sell it? When there's an open market third-party sale, the sale value is what the buyer is prepared to pay and the seller will pay for it after negotiation. That figure can vary depending on the market, the circumstances of the two parties, why they're looking to buy, why they're looking to sell. I'll come back to that, but I will mention that the remainder of this webinar very much focuses on the top 3/4 of this list of reasons for valuation. Those cases where we have to value the business in isolation because there isn't a willing purchaser and a willing seller. We're valuing theoretically, not in the real world. If I come back on to why that's different from a sale in the real world and why real world sales can vary significantly, I'll take an example of a business where the owner needs to sell in a hurry. Perhaps they've received a terminal prognosis for cancer. In those circumstances, their priority may well be to get shot of the business quickly, receive what they can for it because they're trying to protect the employees' jobs. In those cases, someone might be able to buy that business for less than what it would normally be worth. Another example for that might be a business that's struggling. It might be going into administration or liquidation if it's not sold quickly. Conversely, there are cases where a purchaser may well be prepared to pay over the odds for a business. For example, they're trying to lock a competitor out of the market. So as you can see from those examples, where a business is genuinely being sold between three parties, Depending on the reasons for the sale and the party's bargaining power, the valuation could differ significantly. In these circumstances, a formal valuation is probably not appropriate. What you'll get for your business is what you can achieve. So if I then come on to the basis and methodology for valuing businesses, first of all, we need to look at what the reason for valuation is, and that will determine how we value it. There might be something in the shareholder agreement that sets out a specific basis for the valuation, but in most cases, we'll be looking to establish a market value for the business. When we're looking to establish a market value, there are a number of different methodologies which can be applied. The most common of those is an earnings-based methodology. We'd look at ideally future likely earnings, but more commonly historic earnings. Apply a multiple of that, which I'll come on to later in the webinar, and then add surplus working capital or deduct any deficit on working capital. And at this point, the second recording of the main live webinar goes live, so please flick over to that one.